The S&P 500 is a reliable foundation. For decades, it has served as the gold standard for preserving and growing purchasing power with minimal drama. But 10% average annual growth requires a lifetime of patience. For those looking to build wealth on a shorter timeline, the traditional route feels too slow. This is why investors are drawn to Bitcoin. It acts as an aggressive growth engine, capable of massive vertical spikes, but it is also prone to stalling and plummeting without warning. If you want the possibility of those higher returns, you have to trade the predictable safety of the stock market for a level of volatility that most people cannot stomach. The reality of a crash is visceral. A single news cycle can trigger a liquidation event that wipes out 40% of an investment in a single afternoon. Most people think they can handle it until they see their life savings evaporating in real time. That fear leads to the most common mistake in investing: panic selling at the very bottom. Then, when the market eventually recovers and hits new highs, that fear turns into greed. Investors rush back in at the peak, desperate not to be left behind. The real barrier to success in this market isn't the price of the asset. It is the predictable, self-destructive nature of our own emotional reactions. For the last 365 days, I ran an experiment designed specifically to bypass these human instincts. The parameters were hyper-granular. I invested exactly $1 single into Bitcoin every day, regardless of what the news was saying. This is known as dollar cost averaging, or DCA. By setting a fixed rule, you remove the choice. No checking apps, no reading charts, and no timing the market. It transforms the process from a high-stakes guessing game into a cold, automated mathematical routine. Look at what happens during a crash. As price drops, your dollar automatically commands more purchasing power, forcing you to buy the dip. At maximum market fear, you automatically acquire the largest possible fraction of the asset. When the market spikes and everyone else is buying out of greed, the math does the opposite. Your dollar buys a microscopic speck, preventing you from overinvesting at the top. My portfolio value still dropped heavily at points during the year, but because the process was automated, I was never given the chance to panic. By systematically inverting our human instincts, dollar cost averaging forces the investor to act rationally when the rest of the market is at its most irrational. At the end of the year, my total out-of-pocket cost was exactly $365. Despite the roller coaster, the experiment finished with a solid return. But a single year is a small sample size. What happens if you project this exact daily strategy over a 7-year historical timeline? Over 7 years, you would have invested about $2,500. But because of how this asset has grown historically, that small daily habit would have turned into tens of thousands of dollars. When this level of discipline meets a fixed supply asset over long periods, the resulting growth has historically far outpaced what most investors achieve by trying to trade the swings. The blueprint to replicate this is simple. Pick an exchange, set a recurring $1 daily buy, and walk away. Many people claim they don't have an extra dollar a day to spare, but the truth is that standard consumer habits are often shattering your financial potential before you even get started. A $5 daily coffee habit is an expensive trade-off for your future wealth. Click the video on your screen right now to see the math behind your daily spending, and I'll show you exactly where your investment money is hiding.